welcome back to Futures Edge Podcast. I'm Jim Urio with co-host, brains behind the operation, Bob Iacino. And the first one we do of every month, we concentrate on technicals. And last month, I thought it was fascinating. We had Mike Arnold, who's chief technical strategist and co-founder of Path Trading Partners, owner of 5 dogs, all around funny and good guy. I would guess a deadhead based on the fact that he wears tie-dye most of the times when I see him. But you know, it's fabulous. And Bobby and I both like the technicals a lot, and we consider ourselves technical strategists combined with fundamentals. But talking to someone who views things somewhat differently than me, I thought it was fascinating. I learned a crap ton, and I really, really appreciate it. Thanks for coming back, Mike.
You were welcome. Thanks for having me back. Glad to be here.
Was I right about the deadhead thing with the tie-dye or no?
Yeah, I'm a huge deadhead. I'm a huge dead fan. And I just like the tie-dyes. You know, when the weather gets nice here in Chicago, I like to put on the tie-dyes and celebrate a bit of summer. And, you know, I got the all-seeing eye, or the eye of the world, on today.
Very cool. Yeah.
Yeah. Winter too.
What was that?
At my restaurant yesterday, I had.
Well, it's not just summer. I've seen you in those things in winter.
It's not as often, but you can't see them as often if I put them on, because I have to I'm bundled up like in a jacket all day long.
Last night at my bar, my playlist, I put in a row, Bertha, Shakedown Street, and a Touch of Grey. And some guy was sitting outside on the deck chairs listening to the music and just like, wow, this music takes me back to my youth. And I'm thinking, for me, it takes me back to last week. I kind of listen to it all the time. So, right? Yeah.
I've been listening a lot because, you know, it was the 50th anniversary of the 72 shows. So, you know, I've been going essentially all spring, even now, I've been re-listening to every 72 show that was remastered a few years ago. So
that's outstanding.
That's
cool.
Been the listening cycle.
That's really cool. Okay, so I know when we have Mike on, I just have to give him a topic, give him his charts, and then I can sit back and drink my tea. What are we going to start with? We're going to start with equities, and this is kind of a month ahead look at technicals. And you know, how just the longer term trends, and then Bobby and I will take it down to more immediate term trends. And Bobby, after he talks about it, do you want to pepper in some fundamental analysis with each topic, or should we wait till we're all done? It's your call.
Sure. No, we can do that.
Yeah. Okay, good. So Mike, let's start with ES. Is that what you want to start with first? Is that cool?
Yeah. Did you need to have my charts up, or are we good?
Yeah.
Love your charts.
I think multiple participants can share simultaneously. So go ahead. I think I changed the settings so you could share.
Yeah, because before it wouldn't. Yeah, let me just get this up. There we go. All right.
There we go.
So we got.
But just to remind people, we're recording this on Friday. S&Ps have taken a pounding today, nasty, after the jobs number came out. I personally think part of it was that now the Fed, you know, pretty much has to keep going. And but anyway, there's a technical element of that as well. So that's where we're standing right now.
Well,
what do we got here?
Is bad good and good bad? I mean, that's
where
we're sitting now. What's interesting, first off, for any of the financial futures, that would be the S&P, the NASDAQ, the Dow, and the Russell, we're all in long-term sell signals. So first, let me stress that. So longer term, we're watching for more rollover plays. Again, from the macro perspective, since this is a monthly thing, it could roll over any time in the next few weeks. We have the Fed meeting coming up on June 15th. Now, from a more of a micro perspective, starting on the weekly, we still have weekly cycles moving up, and I'm looking for them to top within about the next week, sometime pretty much before the Fed meeting. We're looking for weekly cycles to top and roll over. We've entered a key area on the weekly chart where we are into the week. We've poked in before the big sell-off today. We poked into the weekly rotation zone, just into it, and we're starting to turn down. But if we look at the daily cycles are topping and rolling over. But so far, even with today's price action, we've pretty much just had a sideways correction over the last few days. And on the 27th of May, we triggered a very reliable double bottom pattern and only hit the first target. So where does that put us? That puts us in, we could continually see choppy to a little bearish pullback, but still higher prices within the next week and a half. and I'll list out it would be retesting the 41.89, then 42.37, then 42.84. Now, other caveat with today's price action, if we were to get a close with before another strong rally update, if we were to get a close below June 1st low on the S&P, the 4,071.50, and that would be a daily close, then we'd be looking for a short-term, even bigger pullback to around first target 4,012, second target 398, 39.83, and third and final target 39.54. What's interesting with this also, pay attention, because if we did come down and hit that final third target at 39.54, if we close at or below that level, then the probabilities shift, where then we have probabilities of retesting 38.56 to the lows back from the 20th of May, which are 38.0750. So we're sort of in that mixed market conditions. Unless we trigger that daily close below 39.54, we could see a continued pullback. However, unless we, again, close below that level, we have probabilities that still favor another push higher before we get the next big rollover.
So I'm long Mondays, 41.20 calls, and Wednesdays, 41.50 calls. You think those are reachable because you're saying in the shorter term, we still could see some upside unless we close below what level one more time?
39.54 on a daily closing basis.
Okay, so I need to know, because are those calls going to make me money? So like I said, I told you before the show, the last couple of days have been hot. Am I still hot?
Yeah, I mean, longer term, I'm going with the probabilities that we're still going to see one push higher. And to reiterate, weekly cycles are still moving up and not yet topping. Daily, the only thing with the calls are you have to be right on your timing. And this is going to get tricky because we could see with the daily turning over, we could see some choppier price action in this unless we get that close below the June 1st lows. And then I'll start targeting that intermediate pullback. And the only way I target the larger pullback is a close below 39.54.
Right. And I have the 41.20, 41.70 basically call spread, which was part of a fly. As Bobby knows, I love to express direction using like imbalanced call flies or put flies. And then I took it off at the further point off. So now I just have the call spread left. So all I need is 50 ticks. I don't think that's too much to ask. Bobby, do you have any questions so far on this?
No. So the analysis fits what I've thought for a while. Now my equity opinion shifted a little bit this week. If you look at what Mike has on the screen here, you'll see 2 down days and then a strong up day. And then we obviously have today, right? And that little last 4 candles there. So down 3 of the last 4. And really across those 4 candles, we're pretty much unchanged. We're slightly lower than we were on the close of what looks like the 27th. I mean, we're slightly lower. All of that activity, and we didn't really move that much. Now, from that perspective, I've been looking for sort of a medium-term bear market rally over the last couple of weeks. And my first thesis, and this will go for all 3 indices, so I'll probably keep my mouth closed until we get to the Russell. But my thesis was that the Fed was not going to have the courage to continue to press inflation with rate hikes, and that at some point they would pause. And then Friday, Raphael Bostic basically said it, right? He said, we'll likely see a pause after these next 2 rate hikes. I'm paraphrasing. But then
two people walked.
Oh,
yeah. You go.
He was one of them. He was one of them. It wasn't just Waller and Brainerd. Raphael Bostic actually said people should not take what I said as that there is a Fed put, which is basically what he said. But then he said, no, I didn't say what I said. I said what I said, but I didn't say what I said. So he basically walked that back. He obviously got scolded, in whatever form that scolding takes.
I'd love to be a fly on the wall one of those meetings. It's like, dude, we told you not to say that shit.
Why are you saying this? Yeah, you're right, but why are you saying it? So what can happen here is I expected that now they're all putting pressure on 50 basis points. 50 basis points are going to keep hitting inflation. I think it was Waller that said we might stop doing 50, but keep doing 25 in the subsequent meetings. And the markets did not collapse. This tells me that regardless of the probabilities, I love double tops and double bottoms because when treated correctly, and Mike and I within Path Trading Partners have very strict rules as to what is a double and what isn't, and where targets are and where stops should be. And when it's used properly like that, they are very reliable patterns. They're not 80%, but they're also not 50. They're somewhere in that range. Mike could probably say with a little bit more accuracy the percentage of these things, but I love these patterns and it fits my fundamental view. So you'll see when we give our trades that I'm taking advantage of this.
Mike, can you just do one more time, go over the double top, double bottom scenario and the things he was talking about, just so everyone totally gets it before we move on to something else?
Sure. We've already triggered the double bottom pattern. Okay, that's already been triggered and we hit the first target. And the probabilities still favor, especially hitting this 42.37 target on the next rotation back up.
Where are the double bottoms you're talking about? Where's the one
Go
bottom?
through
There's
the,
the
go
one.
through the
bottom
setup
was
of
from
it,
the
Mike.
12th
Go
of
through
May.
go through very briefly just the rules of it.
Sure. Without getting into all the different technical levels, you need two bottoms within a certain percentage of each other. The first bottom was from the 12th of May. The second bottom was from the 20th of May. The peak was from the 18th of May at 40.95. The trigger was when you get a close above that.
Oh, yeah.
All right. Now, this can still be traded on pullbacks, so you don't just have to buy the close. You can position yourself better, but we also hit the 41.89 is where we look to move up a stop. All right. Because in case the pattern fails, that's where it's most likely to fail. We have hit that target. Now, the next target up 42.37 is raising stop and or taking partial profits, and especially when you're going counter trend. And why I say counter trend is because we're against the higher time frame rotation zone. That's this blue line and orange line. So anywhere in this area, we could fail and roll over. So that's where I mean, from my perspective, I look to raise a stop more aggressively at 42.37 and take something off the table. And then 42.8450 would be the next target, which interestingly enough is right by this prior major resistance band from the end of April, beginning of May.
Good. I'm glad you threw in the word major because I was going to use that too, because that's something even the most novice technical person would look at that and go, obviously that's a level of importance where every one of those bars turned tail and ran, right?
Well, so it's interesting here, Jim, because if you look, so everybody knows a double bottom looks like a W, a double top looks like an M. But what a lot of people don't realize is that in order for a reversal pattern to work, it has to be reversing a prior move, right? So a lot of people will look at two tops. Like if you look at the high that looks like it's about May 26th or so, and then you look at the high that's maybe, April 26th or so, and then there's one around May 2nd or 3rd. Some people would call that a double top. It's not, because in order for it to be a technical double top, there has to be an up move coming into that for it to be reversing, right? And there's not in this case. So that's not a double top. That's just two tops. Now, in the case of this double bottom, we do have a move that it's reversing. Okay, there's the down move, a bottom, a peak, and then another bottom within the percentage range that we've calculated works. And the target does not exceed the move that it's reversing. That's also very important. So if the measured move target were to go up above that move that it's actually reversing, then it's tougher to reach that target. So this one plays out really nice, and still it's not 100%. But it plays out really nice. So I really like this pattern. I think it's likely to work, but you know, it's just, in order to be a good trader, you have to take all the good trades and know that some of them aren't going to
Speaking of good trader, and I told you guys before we started that I had about a month of, just you get in a little bit of a slump, and it wasn't anything major, and then I've kind of gotten out of it. And there were days where I'd go for my macro charts and be like, I want to trade this from the short side. I want to trade this from the short side and go down, down, down. And then I'd look at the shorter term chart and go, oh, that looks like a buy place right here. And then buy it. And just, it seems like when I act like a moron and go against what my plan ledger said for the day is when I lose money. And I guess when I trade the equity market, I think deep down, I'm thinking of the greater good, and I have an upside bias. And again, an upside bias is probably best in that, I mean, the stock market's made up of companies that are trying to shed unperforming divisions and assets and consistently trying to replace them with performing. So it does have an upside bias over time, but just going against your plan is just what I do sometimes. And I have to slap myself and remind myself not to. Mike, do you want to move on to another asset here?
Sure. Let's just go. Let's get through the major financial futures. I can go through the NASDAQ a little quicker. NASDAQ, we still starting at the weekly. You can see here how we've run up just into the weekly rotation zone and also pausing there. Very similar to the S&P. Cycles on the NASDAQ are still also turning up. So watching for a continued push higher. NASDAQ also triggered a double bottom pattern. However, did not even get to the stop reduction target yet. I'm treating the stop reduction target, which is 13,046, with not just a stop reduction, but also a take partial profits. Why? Because we also have a 50-day exponential moving average, which is very significant right at that level. So that only is not just, that's a little tighter trade right there. Then the next upside targets are 13,272 and 13,499. So 13,500 if it were to complete the full pattern. And also, as Bob pointed out last time, it is reversing this move. You have not double top up here, but two tops, and this pattern takes you right to the back right to the top of it if it were to complete. Now,
and that level is basically the same as the 4280 plus or 4290 level in the S&P. Is that same level there, right?
Correct. Now, the probabilities on this double for the NASDAQ favor more the first and second targets. So just keep that in mind. It can hit the first target, and it is within the weekly rotation zone. So that is fully possible, but it's a lower probability to get all the way up to that 13,500.
Okay, so here's something.
If I could, Jimmy, real quick, tighten this back up, Mike, and leave the daily up there. One of the things I love about technicals, and this happens all the time, notice how that first stop reduction target, by the way, Mike gets his targets by measuring moves out. He doesn't look at past price action and line things up. Okay, so all his levels there come from a measured move target that he uses a tool that he's customized within this platform. Notice how the stop reduction target ties in exactly to that 50-day moving average. Notice how the ultimate target ties in exactly to those early May highs. These things happen all the time with technical analysis. You'll put something up and all of a sudden you'll go, wow, that matches up with this. Wow, that matches up right here. That doesn't make it a higher probability. It just shows that price action and technicals is basically what's happening behind the chart expressed on the chart.
Okay, so my question for the range that you picked, go back to where you just were a second ago, Mike. You picked the high of that consolidation in early May, right? And then the low of the low. And then within that, it breaks up into your, what is your increments?
What are these increments? It's 13,046, 13,272, and 13,499.
But that's how you picked your range, is what I'm saying. The top of that, the area we said is a massive importance.
It's a measured move from this low to this high. So from the low on the 12th of May to the high on the 18th of May, and then it's the 50, you take that measured move, you project it from this high, and then it's the 50% of that move, the 75%, and then 100%.
Got it. Okay, that makes sense. And that's not what I thought we were talking about, but now I got it clear. Okay, one more question too. On the daily, you see that red engulfing candle. If we had some weakness below that candle on Monday, all bets off to the upside?
If we get a close, not all bets off the upside. That was the next thing I was going to lay out, actually.
Oh, good.
Because again, you have to have, I always like to have the bullish and bearish roadmap, because that keeps me sane and prevents me from getting caught up with the blinders on to say, oh, the market's got to do one thing only. which, and in these market environments, the things can change in an instant. In a day, it can be a quick reversal. So, but a close below the 2nd of June's low of 12,442.50, and that's a daily close. Then we have a short-term downward bias with the first target being 12,218, the next target being 12,122, the final target being 12,002. What's interesting, if it came down and completed all three targets, if you close below about 12,000, let me zoom in, 12,036, that if you close below that level on the daily, so you could hit all three targets and then bounce back up and not close below that level. But if you close below 12,036, then it favors statistically a return to retest 11,671 to about 11. Let me give you exact 11,491.
That makes sense. I like that a lot. Bobby, the fundamental argument, it seems to me, for NASDAQ is that it's going to be a little bit tough sledding if rates are going higher. NASDAQ hates higher rates. The Lyle Brainerd conversation yesterday, where she, who's uber dovish, said, yeah, no, we're not even thinking about pausing, whatever. And then the numbers today, which gave them kind of clearance to not pause. Is that the entirety of the NASDAQ weakness fundamental argument?
I think today it is, sure. The interesting thing about, again, we're recording on Friday, and the interesting thing about the jobs numbers this morning was that wage growth was lower than expected and lower than the last month, but not enough to make anyone think that inflation's going away anytime soon. And the jobs market was just strong enough for people to think, wow, okay, they're still building. They're still building on these wages, and they're still likely to give out signing bonuses. My wife just got one for starting a new job. She just got a signing bonus. So it wasn't enough to back the Fed up. And as you mentioned, the NASDAQ hates higher rates. And if you look, we go back to the end of April to the end of May, rates were actually lower at the end of May than they were at the end of April by about 3 or 4 basis points across the curve. And then in 3 days in June, we're higher than we were at the end of April already. Right. So it's pretty big moves in the 10, 20 and 18, 20 basis points on the yield. So I think it's entirely an interest rate story for today.
But I'm willing to bet a shiny new dollar, and I'll see if you agree with me on this. That's the Dukes in trading places, right? A shiny dollar that they go 2 more 50 basis point moves, and that's it. I think that they are going to tighten until they break something, and their perception will be that they have broken something at that point. Are you with me on that or no?
Well, I've been with you until all these aggressive walkbacks.
Yeah.
When we saw the aggressive walkbacks this week,
right.
One thing, in the same way that I don't want to fall in love with a losing trade, I don't want to fall in love with a fundamental idea when all the guys who are actually going to implement that idea are telling me that's not going to be the case. They could be lying. They certainly could be lying. They do say they're data dependent, so you never know.
Well, I think that they're just, and we've said on this podcast a million times that there's a level of incompetence there. I mean, they really should have been tightening a year ago. They were buying mortgage-backed bonds into just a headwind of a massively red-hot housing market that everybody on the planet saw, yet they were supporting it with mortgage backs. So now all of a sudden, things are weakening in the economy. That seems to be relatively clear, although it wasn't very clear in those numbers today, but in some other things. And then all of a sudden, they're talking about tightening until the cows come home. To me, it just seems like they're always, as my old coach used to say, hitting second and getting to a spot like that second after you were supposed to get to that spot if you were really playing and zoned in the game. But anyway, we shall see. Mike Arnold, what asset you want to go to next?
We'll jump to the Dow. What's interesting with the Dow, again, similar position, weekly cycles still turning up, but not topped yet and rolled over. So there is potential upside. Closed last week into the rotation zone. The Dow's interesting. It did not form a double bottom buy signal. There was just some other divergence buy signals. So we still had the rally, but we do have that same potential double top signal on here for a pullback move. Now, if we don't get that pullback move, which I go which I'll go into in a second, and start breaking back above about 33,400. I'll just give you the next major target. The next major one is 33,595 and then 33,790. The reversal play is if we close below the low from June 2nd, which is 32,491, and that would begin a daily close below that level. The targets then would be 32,078, 31,872, and the major target being 31,6, about 665. Now, if we got a daily close below 31,655, which these targets line up completely with another statistical measure we use, the 62.5% retracement harmonic. If we got a daily close below that, then that means statistically with close to 70%, we should target 30,940, and then the potential somewhere between that and the potential May 20th lows of 30,585.
So tell me this, is it safe to say that consistent among all three indices is that if we close below those June 2nd lows, that's where things statistically get a little more dicey, volatile, and negative, correct?
Correct.
Yeah, okay, good. That makes sense to me. So good. Anything else you want to mention?
Yeah, and one other thing. Now, if I had to pick between the big three, the S&P, the NASDAQ, and the Dow, my first choice on the next rotation move back up, because we've only hit that first target in the S&P, and based off the technical positioning, I'd be looking to target the S&P first and foremost, just because of the strength of that pattern to the upside. To the downside, I'd be targeting the NASDAQ.
Okay, interesting, which suits the fundamentals that we just said too. In weakness, NASDAQ should suffer more because the weakness probably is fundamentally caused by higher rates. I like that. I think that's fascinating. Do you want to get out of stocks into something else?
Well, let me just glance at the Russell too really fast. Right. We don't have to fixate on this one because the Russell also had a double bottom pattern, which has virtually hit the first target, just missing shy of it. It's at the same target with a potential double top. But the Russell has actually held up pretty well. So separate from those big three, on a move up, I don't mind jumping on some potential Russells. Now, the Russell only has the two high probability targets, 1913 and 1949. Why? Because this is essentially the move that created the double, as Bob was talking about, and the third target is beyond that move. So that statistically drops in probabilities significantly, but the second and first targets are completely in play for a Russell move higher. What really would trigger something to the downside then is if you get the close again, and this is a close below June 1st low. So not the second, but the 1st of June at 1827.50, you get a close below that. We're going to get the bigger pullback in the Russell.
So this is a question for both of you. I'll go with you, Mike, first. Is that a recipe for a pairs trade, long Russell, short NASDAQ in your view?
You could. I'd really need the sort of the NASDAQ to trigger short. I'd be more in favor of that if the NASDAQ triggered short and the Russell held up better without triggering it.
Which could easily be because the NASDAQ's trigger is a more shallow decline than the Russell's, correct?
Correct. So this could even come down and hold up better without triggering, and the NASDAQ could fall more. So on a pair trade basis, yes, they're both declining, but the NASDAQ's declining at a much faster rate. So you are making money on your pair trade.
Robbie, you like that trade or no?
They're still pretty highly correlated, but yes, that can absolutely work. I would rather see the Russell hold, basically like Mike said. I mean, if the NASDAQ triggers, theoretically, I would get in that trade regardless of what the Russell does, right? Because again, as I mentioned earlier, in order to be a good trader, you have to put on every good trade you see. So you can get in that NASDAQ short trade. And then when if the Russell were to hold, almost leg into that pairs trade rather than put it on all at once.
Yeah, right. I got exactly what you're saying. Or if you just are short the NASDAQ, it's essentially, the pairs trade just without that one leg if it's a negative trade, right?
Yeah, I want to give props to one of our one of our actual members at Pat Trading Partners pointed something out that I thought was super interesting. Mike, can you throw up VTV real quick? And then we'll go
What's
back to
VTB?
it's the Vanguard Value Fund.
Okay.
It's the ETF. And
Sure.
it actually has a decent chart, right? It's pulling back a little bit right now, but it has a decent chart, and it showed some real strength for 2 of the last 5 days. And it kind of gives the impression when you look at value versus like the NASDAQ, for example, that it's a lot stronger than tech is. Now, again, this is a value ETF, but if this were to trigger and people wonder about these things, value is probably going to outperform to the upside. So it's just a quick comment. I don't remember who said it. Mike, I don't know if you do.
I think Christoph does, because I follow it.
Might have been Christoph.
I do a weekly sector overview every
Yeah.
weekend up on YouTube that's pre-recorded. And this is one of the things I've started to put in there because, again, we had a double bottom pattern. It's a little sloppier because this is the move it's reversing, but you have this area in here. So it's not as high probabilities. But what do I use this for? Because then if this continues to rotate back up, then I start really looking for strong value plays in individual stocks.
Right. It's obviously a futures podcast, but I just thought this was interesting in relation to, for example, like the Dow versus the NASDAQ.
So Michael, looking at that chart for me, the 2 days ago, the June 1st, the red candle, taking out that high to the upside, if we can do that, probably even less than that, breaking out of that channel, to me, it would seem like an indication for a buy. Do you need a close? Or can a trade above that trigger you to be long?
Okay, and what I teach people is, if you're new, I wait for the close. The way I like to do it is I like a break above a key level on a shorter term chart, and then a retest that level that holds. So bar waiting for like a daily close, let's say we had a strong break, especially above today's high, 143.86. So I saw a break above that. Let's even go with 144. A break above 144, a slight little intraday pullback to 144 and a rotation back up. I can essentially front run the potential closing pattern. So it gets me in. Now, if then we turn around and have a very weak close, toss the trade aside with minimal risk. But that's a way, especially with a nice flag pattern. So we had a run up, a nice little flag pullback. We get that rotation back up. Hey, I'm looking, not only can you play it with the VTV, but you could play it with anything value oriented that had a good individual chart pattern.
Excellent. I love that. Okay, now can we get out of stocks?
Yeah.
Yeah, where do you want to go to? It looks like you were about to take gold, which one of my trades is gold, and I want to hear what you think of it.
Gold is trying to put in a longer term bottom. As long as we hold above 1820 on a closing basis, it's, again, pullbacks. I'm looking for short term pullback buy opportunities. If we get below 1820 on a daily closing basis, that favors then a retest of the lows between about 1796 to about 1786. So that's my key line in the sand on gold. You see, I really wish there's an option for the futures to be settled in physical delivery, because we would probably get a little less of these more call them extreme moves that can be present with cash delivery. But that's just a wish of mine. Now, we have run up. We did break out of above this little resistance shelf of 1865, smacked into that 50-day exponential, and this is one of the reasons it's on the chart. You see, stopped this rally. This rally just came shy of it, and now stopped this rally. So in order for me to get really aggressively bullish, I'm looking for the close roughly above. And one other key thing is on the key level is this 50% harmonic at 1880. So really above 1880, 1881, we get a daily close above that. I start getting much more aggressively bullish. Until then, I have to wait for shorter term pullback buy patterns.
I thought CME silver and gold contracts have been forever settled in physical delivery. That's not the case any longer. What's going on?
They're settled.
They're cash.
They're cash.
They're cash settled. Okay. All right. Forget it then. Maybe I'm not the futures expert that I play on TV. I really thought they were. I'm never going to take delivery on them. I don't want to have to deal with that too. But I've always
Hey,
gotten
I'll
out
take
of them ahead of
delivery
time.
of a truckload of physical silver.
But I don't want to have to deliver any to you. So, right. So that's, yeah.
Well, you can help me unload the truck.
Okay, good. Yeah, because spot, that's just the thing that's so amazing to me is if you notice in the gold and silver markets over the last several years, the premiums traded in the physical are much, much higher than they normally were. I think gold physical trades that are usually about a 4% premium to paper, and it was up to like 8 or 9%, and silver was the same. And I was always wondering that why people weren't just taking delivery, but now you guys have answered the question. I guess you can't know everything. Sorry about that. Bobby, you got any thoughts on this?
Yeah, we're about to enter a very strong seasonal tailwind in gold. Now it's short-lived. It's like the last 2-3 weeks of June, and then the first week of July or so, second week of July, and then we hit a pretty strong seasonal downdraft. So it's nice to see this kind of like short-term strength with the seasonal tailwind we're about to get.
Okay, interesting. I'm going to my trading gold. We're going to do toward the end of the show is a short, but it's technical and it's not. I tried. I had to stop working below where the market was, and based on what Mike said, I think he's going to like my target. I think he's going to think my entry point's too early, but you got to watch the rest of the show to get that. And my fundamental thesis is just the same thing we were saying about a lot of other things: is that the Fed in the short term has definitely made it a point to say that they are not planning on pausing anytime soon. And the dollar rallied a bit too. Some of the currencies that I was long, I got stopped out of for winners. I talked about on the Ninja Trader show we did the other day. I was long Canada. I also had been long Aussie dollar, and I got stopped out of those still for gains, but for less than I thought. And I think that most things that are dollar related, dollar's probably going to rally and things are going to go south. What other asset you want to hit here? What Bitcoin you said earlier, I remember?
Well, let's hit crude first because
good.
Fantastic.
Yeah.
Crude for me was on the break back from once we broke above the 23rd of May highs. It was test the upper channel bound with a spike to 118.39, which we spiked above, got a little 2-day pause, that little sell-off into the daily rotation zone, which was a gift. And that was with the OPEC announcement stuff.
Right.
And then we had the strong reversal. And once we closed back on June 2nd, so again, this is Friday, June 3rd, when it's being recorded, that now statistically favors the run up to 125.90 area. Intermediate targets 121, and then the next major target's 125. So even on pullbacks, it's a very strong area to continue to do a bullish play in crude.
Bobby, do you think part of what we're seeing now is any sort of demand destruction that might have been happening domestically is going to be offset by China coming back online? Is that the fundamental story?
Yeah, the China story is a huge part of it. Also, the reaction after the OPEC announcement. So when OPEC announced that they were going to increase their production by about 50%, people have to remember that's them taking back production cuts, right? They're taking the production cuts away. So not actually increasing production. They're going back to more normalized levels. But now, because of the pandemic and for other reasons, they don't have the capacity that they used to have. So they can't actually, the only two with any excess capacity or spare capacity are the UAE and Saudi Arabia. And slowly some Russian crude oil is coming off the market, but not much because it's going to China, it's going to India. And Urals, which is what Russian crude oil is called, is generally discounted to Brent by about $4 or $5. Right now it's discounted to Brent by about $45. So it's trading in the 70s. So they're selling a ton of it to India and China. And now China's coming back online. So they're going to be buying more. So they're going to be coming back into the market. They've been buying all the crude they needed basically from Russia. And that was part of the weakness that we saw at the beginning of May was China's lockdowns. So now they're coming out. Urals is at a discount. It's being sold. So at the end of the day, OPEC's decision to pump more means nothing if they can't actually pump it.
Okay. That makes sense. I know, normally we have macro guests on and we do a whole macro thing, and this is not really the show for that too, but do you share my frustration? It seemed like being energy independent is such an enormous natural security level that we should have achieved. And it seems like we have clowns who don't want to do that at all. We're still pumping what, 11.5 million barrels a day when we were at 13 million prior to the pandemic, where our demand is higher. Do you have any thoughts on that?
We should have had, so number one, about 30 years ago, 40 years ago, give or take, there were 250 refineries in the US. Now there's about 100. There hasn't been a refinery built in the United States in 10 years.
Because of regulation.
Yes, and they take about 10 years to build and to turn profitable versus investment. So no one's going to build one. I was watching an interview with the CEO of Exxon, and it's really a shortage of product that we have right now in the US that's causing pump prices to go so high. Crude oil prices are the secondary effect. That just means we're not going to get relief at the pump. But we don't have enough refinery capacity, and we don't have enough pipeline capacity globally, but mainly in North America, to move the crude oil that we do have through the refineries that are already basically running at full capacity. So it's a problem that's not going away tomorrow. And it is basically due, for the most part, there's other factors, basically is due to regulations, because if it wasn't for the regulations, we would have enough spare capacity and spare refineries to absorb any hit from the Russia-Ukraine invasion. And we don't have that capacity. It's like somebody who lives check to check. If you live check to check and you take a hit, you're in trouble. Well, we live barrel to barrel. And now Russia and Ukraine is making us take a hit, and we don't have the capacity to absorb it.
Mike, you got anything more about this chart?
Yeah, because I like to give the bullish and our potentially bearish / pullback case. As long as we do not get a close below 111.20, even on a pullback, it stays bullish. A close below 111.20, then my target is about 106.85 to 107. So that's the only area that I'll start watching for the bigger pullback. Which
coincidentally was the June 2nd low. So many of these assets are so correlated, because it just blows me away that we can look at these charts of things that should be unrelated, and they're very quite related, actually. Do you want to move on to Bitcoin?
I have to point out something before we go on to the last asset with Mike. On the 20th, the podcast that we recorded on May 20th, I talked about being long crude oil with a target of about 123.70. And then last week, I talked about buying the 114 calls for $3.20. I exited the crude trade today. I exited it early because going into the weekend with the few extra days for the few extra dollars, it's not a correct thing for me to do. I was trailing my stop, but since I had the options on, I did it. So that crude oil trade is over and profitable.
Nice. That was a great trade too. Well done on that. Yeah. All right, let's get to Bitcoin.
Bitcoin.
The only reason I keep talking about Bitcoin is it seemed like 4 days ago, that up move was like the signal for the grass is green. Let's grab it all. It's going back to 40,000. And then I was so surprised by the quick reversal. Can you tell me why I was wrong in thinking that?
No, you had the daily rotation zone in the way.
Yeah. Silly me.
You'll get these on all your charts going forward, Jim.
Yeah.
Watch.
By the way, see, Bitcoin long-term, even on any rallies, even on a rally to fill this gap up to about 36, the gap fill would be on the futures to about 35,925, even to the 50% harmonic from this major up move. Even if it went all the way to the other side of the daily rotation zone back to 38, it's just potential sell setups. So short term, even if you got the bigger bounce above the daily rotation zone, now if you get the close back above about 31,650, then I'd start watching for a slightly bigger bounce. But that's the only thing that gives me a very short-term bias move, and that would be to some minor upside targets. Other than that, long-term, I'm bearish, especially with what's going on from a fundamental perspective with with some stuff unraveling. You have some coins unraveling. You have the issues with the Celsius network. We've had Terra and everything else, go south. And I'll give you the next targets. If you get that close, and that would have to be a daily close. If you want to be a little conservative, 31,700. You start getting above there, your minor targets are 33,350 roughly, and 34,230. And then it would be for that full gap fill play up to that 35,925 area. Now, bearish, because we got to keep the bearish, because we have there's some fundamentally things that are bearish, and technically things even on rallies can still look to be longer term sold. You get a close below of a 27,985, or we could even go below this low just to give it a little more room. The low from May 26 in the futures, which is 27,890. Then it favors a return to test the areas of 26,230 to 25,350. So then I really start getting bearish for the key major breakdown lows.
Wow. Okay, so just to go over it one more time, when you draw your grid there, the lowest part of the grid is from the low of May 12th, and then from the high of just a few days back, the one day I was talking about. So that sets up your grid for your daily rotation zones, correct?
That sets up the grid for the key harmonic levels.
Key harmonic is what I meant.
The
right,
rotation zones are always the orange line, and I always have it on my chart. So if you tune in to anything I do, you'll always see an orange line is an 8 exponential moving average. The blue line is a 21 exponential moving average. And the green line, which we talked about before, is the 50 exponential moving average.
Got it.
And the rotation zone is anywhere between, you see why we use these moving averages. You see how we had this sort of this bottoming candle. Then look at your 8 EMA. You see on the closing basis how it hugged it?
Yep.
Then we finally got the move above it, and it couldn't get the close above the 21, and then it's still sitting here. So why am I watching this blue line? I gave it a little more room just for the sake of this podcast above this key close and open right here. But until it can really get that close above that daily rotation zone and some of these little resistance areas, I'm not watching for the short-term pop. To the breakdown area from this low that you talked about on May 12th to the high on the 31st, if it gets a close below the 62.5 retracement level. So that's low to high. If you separate that and take the 62.5% of that, you get a close below that. Statistically, then it favors returning to the 87.5% to the 100%. And that's with around 70% statistically relevance that you have that downward pressure. So that's why I like to do everything with statistics and these key levels, because I can then map out whether I'm using futures, options on futures, or however it's being traded. I can map out the probabilities and the best course of action to take with structuring the trade.
I love it. Thank you so much, Mike. This, again, and I'm not even being hyperbolic or anything, but when we talked to you a month ago, you've changed the way I look at technicals. And again, you know that I always think I know everything, and then you talk to somebody who really does know a lot of stuff, and I'm just amazed by it, and I appreciate that very, very much. You going to stay on for the trades, or you want to hit it?
Oh, I'll stay on for the trades.
Let's go, Bobby. You're up first.
Yeah, so just really quick for everybody, I think it's interesting to understand how Mike and I became partners, and I want everybody that watches this podcast to listen to what Jim just said. Jim has 30 years experience, and he said, you just changed the way I looked at my charts. You always have to be learning in this business. I was actually giving a seminar, and I had a trading course at the time, and Mike came up to me during the live seminar. He paid out of his own pocket to come to my seminar. And he said, I learned your stuff. There's a lot I like about it. I'm going to use some of it. I think I improved it though. And I'm teaching a seminar, and he's one of the theoretical students in there. And I could have said, you're going to teach me. What do you know? Get out of here, tie-dye guy.
By the way, a lot of people in our business act that way.
Yeah. Yes. And instead I said, great, let's grab lunch or a drink and tell me what you did. And he did improve it quite a bit. So I just wanted to point that out. All right, trade-wise. So I went ahead and played a pullback, on the double. So Mike, if you can put the ES up, I would appreciate it. what I did on the ES here was I put in a buy at 40.06 yesterday and I got it, right? I'm sorry, 40.96. So 40.96 is where I put in a buy, thinking that it wouldn't pull all the way back to the peak of the double. It did pull all the way back, but I was able to get in a little bit higher anyway. I probably could have dropped it those $3 extra, but I didn't. So 40.96 where I went long. My stop is at 4,003. So just below that 40.12 level that Mike mentioned when he was talking about the ES here. I always like to put things a little bit below, right, in order to kind of give it a little room to fake out there a little bit and pop back up. So my stop's at 4,003 and my target is 42.75, going kind of in between or a little bit short of the full target on this. And the reason I did that, I have the same measured target that Mike has, which is up about 42.84. But that open on that red candle of the pair of candles to the left, that opening price, all the way to the left, Mike, beginning of May, that big red candle, keep going to the left.
Sorry.
Keep going. What right there? That opening price right there is about 42.89. I wanted to be well short of that. So I put my target at 42.75. Now this is going to risk, these are micros. So risks about $465 per micro contract for a potential profit of about $895. So it's right around 2 to 1.
Okay, so as I already said, I'm long the 4120 calls and I'm long the 4150 calls. The trade from last week, which has become convoluted and mixed into something else, was long from 4110. Wrote it up, did not get to the target yet. I still like that trade, and still in my head, I'm still in that trade. I'm not in it specifically. I'm actually short some futures against the call position, but the call has a positive delta, so I'm still on the long part of it. I think there is one more move up. And again, we've been looking at that same level, call it 4280 to 4300 in there. And I think that's spot to get out. So I like it too. Overall, I'm still more bearish than bullish in the longer term until we see something fundamentally different from the Fed, but I'm in it. Can we go to my Euro trade?
Shoot.
Okay, so my Euro trade kind of is contra to what we've been saying too, because the Euro probably, if the Euro is going down and the stocks are going up, that it's not unheard of, but it's just unusual. Things are kind of correlated, moving together too. But from a technical setup, it seemed like the Euro had failed a couple times to make any headway. There's a 1.08 level in the Euro that I think, Mike, can you get a Euro chart up quick, or you weren't prepared for it? So you
I
can't
have
get it.
I have it up.
Oh, that is right. Okay, so that the 108 level right there looked like a spot for me of some serious resistance on the upside. So I'm short the micro June Euro at 1.0726 with a target of 105.90 on the downside and a stop placed below 1.0810. So above the level of congestion there. I want to go to Mike first to see from a technical standpoint what problems you have with that trade. And I based on what we've talked about, I think you're gonna, but let's go on.
Well, again, you have it could, unless we get another significant push higher next week. The only issue is you have weekly cycles getting close to a top, but not yet rolling over. You are within the weekly rotation zone. We've got in there, so it could roll over any point. I like this that you're against. We had this prior end of April support shelf, which was broken with momentum. We've come back up, test this, and we have daily cycles rolling over. So that's in your favor. And remember how I talked about that 50, that green line? You see here, rejection closed down, rejection closed down, big close down, move up, but rejection, so far, rejection closed down. So my first warning sign that's going to make the run is if we close another one more high push would be if we really close above this 50 exponential. But the safe stop area is definitely just beyond this prior support becoming resistance.
And that's where my stop is, right?
Yep.
Okay, good. Okay, so he doesn't hate it. Okay.
No,
I feel better.
hate it
I'll
at
tell you
all.
what,
Now,
I like the trade because you're liable to be profitable going into the ECB meeting. It's my thought. Because I don't think people will believe that the ECB will be as aggressive as they probably should be based on the blog pivot that Christine Lagarde did. I think the meeting she'll come out a little bit weaker a little bit less hawkish than she is trying to be. But if she doesn't, then you'll get stopped out of it. But I think going into the meeting, you're liable to get to your profit before that even happens. So,
Right. Okay. Good. Now we're on to gold, and I have another trade in gold. So this is not a trade that I have on. And actually, full disclosure, in my long-term inflation hedge portfolio, I am long gold, not short gold. I'm long GLD, I'm long physical, whatever too. This was a short trade that I was trying to put on today, and I will probably resume it trying to put it on Sunday night. It was a stop of gold, a stop in on a short of the August micro gold at a trade of 1845 with a target of 1792 on the downside and a stop placed above at 1885. Now that trade would make $520 if your target is reached and lose $400 if you're stopped at your level. Mike before said that he thought a close below 1820 was where the magic happens. I'm going in a little above that. Mike, do you think that's a mistake?
I think it's aggressive to the downside. I mean, we're in consolidation. The thing you get, again, you have going for you is you're still below some key resistance areas on the weekly. The only thing I've been watching on the short term is that the weekly cycles are still moving up. We're in consolidation. The dailies are trying to turn up. We've had this little pullback today after the first reaction at, again, that 50 EMA. So it's aggressive from my standpoint. It's aggressive to the downside, especially with that target as far as that target area, because even a pullback, again, from the harmonics I have up here are from the lows of the 16th of May to the high made today on June 3rd. The key area that we could, even if we pull back in the short term, where I'll start watching for a shorter term, like a 1 hour or 4 hour bottoming pattern, is between 1831 to 1820. Anywhere in there, I'll watch for a bottoming pattern for another push higher.
Okay, but if 1820, if I said was my stop in below,
yes,
you'd prefer that.
Yes, if you then get the close below 1820, then I am targeting 1796 to the lows of the 16th of May.
Good. So that's where I'm in there too. Bobby, you got the last word on gold before I shut you guys down and head to the bar.
yeah, I hate this trade, Jim. Mainly because the 200-day moving average, which is the red line there, is much weaker when it's flat, right? Just statistically, but people don't know that. They still think it's the disc. Oh my God, it's the 200, right? And you're stopping in just above it. So if your target were just below it, as you see, like the candle you see there on, I think it's June 1st, where it kind of just dipped below and then popped right back up and closed above. You might be able to get me to say, okay, it's a scalp, it's fine. But like Mike said, the target is so far away. You've got seasonals going against you. You got the 200 going against you. And you actually, you're between the 200 and the 50. I'd rather, as the kids say, F with the 50 than I would with the 200.
Interesting.
So, yeah.
And you know what? As I said, I tried to put this trade on today, but in the last couple hours, it didn't give me that 1845. And is it fair game, since I was transparent above, say that you guys have probably talked me out of it and probably going to move my stop back down to 1819?
Yep.
Okay, good. So we're good. Then we have a consensus. We have a quorum. We can vote. Okay. I got nothing else. What do you got?
I got nothing else.
Okay.
I'm all good.
Thank you so much, Mike. This was a ton of fun. And guys, if you guys don't follow Mike Arnold, you're making a mistake, I think. Thank you guys all for tuning in. I'm heading to the bar. You guys have been great. Thank you. See you, Bobby. See you, Mike.
Cheers, guys.
Thanks for having me on.